Hey guys, so we just wrapped up the fourth annual Tax Rep Summit. Uh, Great time, great energy, and we booked the fifth and sixth annual summits. We'll be posting about that shortly. One thing that came out of the summit was the concept of reasonable compensation. The IRS now is really ramping up the audits on S corporation and S corporation owners. And one of the big hot button items there is reasonable compensation. Now, this affects S corporations, C corporations, and nonprofits that file a 990. The rule is there's supposed to be some backup data that supports the compensation taken by the shareholders or officers um, that determine the reasonableness of it. There's a huge amount of confusion around this. So I thought that I would just take this moment to clarify this so you understand really how reasonable compensation works. So, first of all, let's just dispel a number of myths. Number one, it has nothing to do with profitability. Nothing. And you might be thinking, well, wait a minute, Eric, if the company's not making money, think of it this way. If you went to work for another company, you know what? I'll use myself as an example. If I left Green and Sklar's and just left, the firm would have to hire somebody to take my job. What would they pay that attorney to do the job, provide the services that I was providing to the company, right? That person would expect to be paid, regardless if the company makes money or not, all right? That's the employee portion. So first of all, you have to figure out the reasonable compensation for that person. So if you are an S-Corp owner and you are providing services to your S-Corp, you have to pay yourself the reasonable compensation for those services. So let's assume, I don't know, that reasonable compensation is $100,000. It doesn't matter how much the company makes. If the company makes $5 million or loses $5 million, my reasonable compensation is $100,000. So do I need to be paid wages of $100,000? No. The first money out, up to $100,000, has to be W-2 wages. Anything above that can come out as distributions not subject to self-employment tax. That's where the tax savings are. So let's just run through a couple of examples. Number one, my reasonable compensation is $100,000. I'm providing services to my S corporation, and I pull $50,000 out. All $50,000 has to be a W-2 wages. Next example, I pull $200,000 out. The first $100,000 would be W-2 wages. Anything above that, distributions not subject to self-employment tax. What if I don't take any money? The company loses money and I take no distributions. Or it made money, but I left the money in to reinvest in the company. I don't take any distributions. Now, we all know I'll have taxable income. An S corporation, it's a pass-through entity, but taxable income is not the same as compensation. All right? So I'm going to have taxable income. Do I have to declare any wages? No. I took no distributions. If I don't take any distributions, I don't have to declare the wages. So folks that came up to me after and said, well, Eric, if the company's losing money, and why would it have to pay my client a $100,000 salary? It doesn't. But if the client pulls money out of the corporation, the first money out has to be compensation up to that reasonable compensation number. So let's assume my reasonable compensation is $100,000 and the company loses money and I don't take anything out in year one. Year two, it breaks even, I don't take any money out. Year three, it makes $200,000, I pull the whole $200,000 out. I didn't take any reasonable comp for my $100,000 salary, which is what we've determined, I use RC reports, is reasonable. I would have to make up those years. So years 1, 2, and 3, I should have gotten $300,000 of compensation. So the whole $200,000 I took out in year 3 would be my W-2 compensation, and there's still $100,000 I need to make up. treat the person as if they were an independent employee. What would they expect? They'd expect those missed wages to be made up. Same thing. But again, urban myth number one, it has nothing to do with profitability. The second myth is you have to pay those wages every single year. No, you don't. It's only if the S corporation owner takes money out that they would have to take the reasonable compensation number. And number three, okay, is this, that, I'm trying to think how to explain this. When it comes to comp, it's for the services provided. So what if you are, I got this a lot. Well, Eric, my client's retired. He's in Florida. He owns the S-Corp. I can say, stop right there. This is about services provided. Is your S-Corp owner providing services? Oh, no, he's retired in Florida. Then he doesn't have to take any reasonable compensation. Everything can come out as distributions. He's merely an investor at that point. This is only for the corporate owner who provides services. Okay? So I hope that helps. Now, the other thing is, why do I use RC reports? Well, first of all, it is by far the best at this. 100 million data points. When you get that report, I've dealt with this now in 3 audits. When you provide that report to the auditor, they simply flip through and say, can I have a copy of this for the file? Sure, no problem. That's yours. That's the end of the comp. No, that's the whole end of the comp audit. Okay? What the IRS is looking for are people that are not taking reasonable compensation, and when they show up, have no data or anything to back up the number. So first of all, RC reports, it's going to bulletproof the return, okay? And it's going to let you and the client sleep at night. The other thing we found is when we run the reasonable comp report, we have clients who are taking too much. There's a lot of people that I got to take the minimum, that you need to take to max your Social Security. Medicare is like, I think it's around 165,000, something like that. So they're taking 165,000 as their wages because some accountant told them that was a safe thing to do. You run their reasonable comp report in RC reports, and it comes out at 92,000. I tell the client, drop your comp to 92,000. Now, your Social Security wages are going to go down. But let's take that 15.3% on that 72,000 roughly, all right? So we're going to save them about $10,000, $11,000 a year, and let's put that into your own profit sharing, all right? Put that money into your own retirement account. I mean, I hope Social Security's around, but I'm not banking on it, all right? So let's take that and help the taxpayer save taxes now, put that money away, let it, accumulate and grow much faster than Social Security is going to, all right? We've also bulletproofed their return, so we can sleep better at night if an audit notice comes, shows up, and they can sleep better at night. Now, the other way to make money with RC reports, if you're a CPA or an EA or an attorney who does returns, you probably have single-member LLCs that are profitable. Run them through RC reports. Now, again, you're taking a little bit of a rough cut. If you've not used the software, it asks you to break down how much time you spend on this job, that job, whatever, out of a 40-hour, say, work week. But you might find that your LLC, who is netting 200, 220,000, again, maybe their reasonable comp comes in around 80 or 100. If it's at 100, save them 15.3% on 65,000. Say, hey, look, I can save you $9,000 a year. Now you'll have the corporate return. You got to run the report every December, right, to set your wages for the next year. But we can save you money, have you take that money, put it into your own retirement account, right? And again, you don't have to worry about an IRS audit because the IRS isn't going to come up with anything better than RC reports. I mean, 100 million data points. They've never been successfully challenged, okay? Now, given what I do for a living, I tend to do it reactively. There's an audit going on. We run the report mostly to see what the damage is. Because the other thing is, if they didn't take reasonable comp, you might find auditors that get very aggressive in what they think is reasonable comp. That's why I run the report, because this way we can minimize the damage, because the auditors are not going to be on your client side. They're going to try to aggressively pump up that reasonable comp number as high as they can, creating more payroll tax liability, penalty and interest, all the rest. So hopefully you learned a little bit about how reasonable comp works. Hopefully I have told you how you can deal with it. And for those of you interested in RC reports, I'll put a link in the description to this video where you can go and save money through the tax rep discount. I'm telling you, this is an investment that is worth every dime. And by the way, as a CPA or EA, this should be a moneymaker for you. This is not just part of the 1040 prep or the 1120S prep. The client's got to pay for this. It's got to be part of the deal. And I would just bake it in. If you're doing a flat fee, this has to get baked in, so you're going to have to increase. And if the client wonders, by the way, just as a practice point, why they have to do this all of a sudden, you can tell them. The IRS right now is auditing this. This is a hot button item. We haven't dealt with it up until now. We really need to deal with it. All right? So hopefully you learned something about reasonable comp. You'll learn something about RC reports. I'll see you in tax rep.
Hey guys, if you like what we're doing, you like what we're covering the topics, if you could, please hit like and subscribe. It really helps the channel. Also, if there's something you want us to cover, a guest you want to see, a topic you want us to discuss, email us, podcast@taxrepllc.com, and we'll do what we can to cover the topic, see if we can get the guest on. So podcast@taxrepllc.com. And again, hit like and subscribe. It really helps us. And send in your ideas and we'll see what we can do. Thank you.